if you're going to be playing in this game, you should know how your orders are being executed. And this will be, I'll just touch on a few things here. There are actually 16 options exchanges that are controlled by 5 entities. NASDAQ and the CBOE are public entities. And I'm not sure whether ICE or the Miami Exchange or the Boston Exchange and there are different kinds of exchanges. You'll see the blue represents the traditional exchanges where the customer gets priority, but then you pay some fees. But if you're bidding at the same price as a market maker, you actually will get priority on those blue exchanges. On the other hand, if you're providing liquidity on the orange exchanges, you get paid for making a market. But if you take prices on on that exchange, you actually pay a fee. So those are called maker-taker exchanges. And then there's some hybrids that use combined customer priority with maker-taker that are a little more complex. Volume has grown significantly in the options markets. But at the same time, the trade size has actually gone down. And this is similar to what's happened in equity markets. So in 2010, we had trade sizes were somewhere between 20 and 25, the average execution size. Now it's 6. And the same thing has happened. People are splitting up orders. But on the other hand, the average daily volume has increased. Now, moving on to my favorite stock versus stock, GameStop. I think you've probably heard about this entity, and this sells games. Most of them, they have 5,000 stores, have to close a few stores, not doing very well until the people from Reddit and Wall Street Bets picked it up. And suddenly we have a stock that has gone crazy. Now, with a stock this high, and this is very rare that you get this situation, as an option trader, it's rare that I would take a position relative to the direction of a stock. But in this case, I've taken a position that says this stock is overpriced. So what I've done is I've actually sold calls. And before doing this, though, I looked at some of the short squeezes that had occurred in the past. And I found that Volkswagen is deemed to be the largest short squeeze that has occurred with at least in recent history. And it was the case of Porsche was trying to take over Volkswagen. And it looks like they drove the stock up to 5 or 6 times or 7 times what the value was. But from what I understand, GameStop is worth somewhere around $20 a share. At most, its book value is $8 a share. No, its book value is $5 a share. And so I'm essentially taking a position against it going up. And I'll show you a couple of positions that I've had here. This is my position going into the March expiration. And this is at a price of, I don't even know what the stock price was. We should be able to figure out this. This was more, we can see it was something like, it's somewhere around 200 at this point. Now my March calls are all going to go off. They all expired, or they turned into stock, like the 125 calls that I'm short, those turned into short stock. And then I have April and July. Well, that was a position on March 18th. Now, I don't think I was looking too good. Now, up at the top, you can see the volatilities of the implied volatilities of these 3 months. You see 344, 347, that's the implied volatility. Now, those volatilities actually exceeded 1,000 at one point in the run-up. And I actually discovered this about 4 or 5 days after it had run up. So I got into this a little bit late, but I did short the stock. So I looked, if we go back to the chart, I looked real good at the point that it drops. But then I stayed short the options. So as things ran up, I actually had to buy some stock back in order to stay somewhat within, to do some risk management. And I'm going to talk about risk management quite a bit here as we go on. Gambling and investing are very close cousins. And you can see that in blackjack, at the best advantage you get is about a 2% edge. So if you take an urn and you have 100 balls in it and you have 51 winners and 49 losers, you have a 2% edge. But I think it can be proved through the Kelly criteria that your optimal wager is the difference between the winners and the losers, or about 2% of your capital will give you the greatest growth of capital. So you have a limit as to what you can bet in options. And I could never bet more than 1/50th of my bankroll. That means if I lost money, I had to reduce my wagers. And if I made money, I could increase my wagers. The options are similar. And so I tried to come up with an ad hoc way of managing your risk in options. And I'm sort of putting it down into this. First of all, figure out what your worst outcome could be. And that might be a takeover. A stock might be taken over at twice its listed value. So consider, what could I lose if I had 100% increase in the price of the stock? And then never risk more than 1/10 of your capital on any one situation. And one more trick that's that's one thing. You've got to diversify, and you can't have concentration. You can't do it all in oil stocks. You could do it in different industries, but you have to have diversification. And one of the tricks that people do, and I do, if my position is too large, I end up buying stock as it goes through the strike if I'm short options. Now let's talk a little bit about how selling options is viewed by the investing public and by firms. Here's one of, this is actually a course, Option Trading 101, says never trade naked calls. Here's another one. This is the most dangerous move you can make as an option trader. Want infinite potential losses in exchange for limited potential profits? Then writing naked calls could be for you. Well, they're obviously trying to discourage you, but imagine yourself as the risk manager of a firm, of Robinhood, say. And you've got a person with a limited amount of money in his account, and he's selling a naked option that can lose an infinite amount of money. Well, you're not going to encourage him. And so as a result, because options are so discouraged of selling them naked, options probably are expensive then. So I want to take a look here I want to compare a lottery ticket to options. And I'm saying that selling options gives you a positive expected value, and you're investing if you sell options. But so I'm saying here, just as every investor should purchase a lottery ticket when the expected value after taxes exceeds $2. And this occurs about once a year because you have lotteries that have carryovers that carry over money. The same thing happens with the pick six at the racetrack, where you get a positive expectation. So you should bet on those situations. Well, just as that is a positive expectation, I believe that selling call options on GameStop is a positive expectation. And the only question is how big is to make these bets. So I think in investing or in gambling, making the right size wager is more important, at least as important as figuring out which bet to make. In summary, about options, options are a growing part of the investment landscape, but they're expensive. Selling naked options requires disciplined risk management, and if you have, and the fear of selling naked options is exaggerated. In the current market structure, it's set with 13 exchanges and 45 dark pools where these things operate in milliseconds across exchanges, the spreads are much narrower than they ever were. But on the other hand, we've had a consolidation of market makers. There are only about 10 large option market makers anymore that make markets and everything. And the orders and the spreads are still fairly wide. But I think overall, if I think about overall the efficiencies of the whole system, even with the payment of order flow, it is so much more efficient than it was. And the cost of the retail in consumer is much less than it was certainly 20 years ago.